Hello, everyone. Let me ask you a question. Today, if you had a $100,000 to invest, would you choose Coles or Woolworths? And more importantly, would the financial data support your decision, what the financial data says? Welcome to our presentation. Today, our analysis will compare Coles Group and Woolworths Group across financial year 2023 and 2024, using financial ratio analysis to identify which company demonstrates stronger overall financial performance. All right. When we look at Coles Group and Woolworths Groups, we can say that these are Australia's two largest supermarket retails, and together they serve millions of customers every day. When we look at Coles, which operates more than 850 supermarkets and almost 1,000 liquor stores across Australia. On the other hand, Woolworths operates a larger and more diversified retail network that includes supermarkets, Big W, Petstock, and also New Zealand operation. Our purpose with this report is to compare their financial performance across financial year 2023 and 2024 using financial ratio analysis and determine which organization demonstrates stronger overall financial performance. Before comparing the financial performance of Coles and Woolworths, it was important to establish a consistent methodology. Our analysis was primarily based on the financial year 2023 and 2024 annual reports of both companies. In addition to that, Market Index Australia was used to obtain market price per share data required for the market ratio calculations. And financial information was extracted from the annual report, transferred into Excel, and used to calculate required ratios. The analysis then organized into four different categories: profitability, efficiency, financial stability, and market ratios. Together, these categories provide a comprehensive assessment of each company's ability to generate profits, utilize resources, and efficiently maintain financial health and create value for shareholders. Detailed calculations and supporting financial data provided in Appendix 1 and Appendix 2 of the report. All right. This slide will compare profitability performance of Coles and Woolworths using key financial ratios. Starting with gross profit margin, Woolworths performed better at 27.31%, indicating stronger cost management and pricing efficiency. For operating profit margin, both companies delivered similar results. However, Coles showed signs of improved operating efficiency during the year. In terms of net profit margin and return of equity, Coles slightly outperformed with a higher ability to convert revenue into profit and generate stronger returns for the shareholders. When we look at for return on assets, Woolworths maintained a small advantage, reflecting efficient use of assets. Overall, Woolworths demonstrates slightly stronger profitability, while Coles show better shareholder value creation and operational improvement.
Hi everyone, I'm Lalindi, and on this slide, we compare the operational efficiency of Coles and Woolworths over the year 2023 and 2024 financial year. Efficiency ratio help us understand how effectively a company uses its assets, inventory, and working capital to generate sales and manage day-to-day operations. Overall, both companies performed well, but Coles showed stronger results across most efficiency measures and also recorded improvement from year 2023 to 2024. This suggests that Coles was able to utilize its resources more effectively and operate more efficiently during the period. While Woolworths also demonstrated solid performance and improvements in some areas, Coles generally achieved higher turnover ratios and faster operating cycles. This indicates stronger asset utilization and more efficient management of inventory and receivables. Overall, while both companies showed some improvements, Coles demonstrated stronger operational efficiency across most measures and achieved greater year-on-year improvement than Woolworths. Moving on to the next slide. On this, we focuses on the financial stability and liquidity position of Coles and Woolworths. Financial stability ratios assess a company's ability to meet its short-term obligation and manage financial risk. These ratios are important because they indicate whether a company has sufficient resources available to cover its liabilities when they become due. The results show that both companies maintained relatively stable liquidity position across 2023 and 2024. Although the ratios are lower than 1, this is common in the supermarket industry due to uh, fast inventory turnover and strong daily cash sales. Coles demonstrated a slightly stronger overall liquidity position, while Woolworths performed marginally better in immediate liquidity measures. However, the difference between the two companies were relatively small. Overall, both companies appear financially stable, but Coles holds a slightly advantage due to its stronger overall liquidity performance and consistency over the 2-year period. To conclude, Coles demonstrated superior operational efficiency during the period, outperforming Woolworths in most efficiency measures. In terms of financial stability, both companies maintain a stable liquidity positions, with Coles showing stronger current liquidity and Woolworths maintaining a slightly stronger quick ratio. Overall, both the companies remain financially healthy, but Coles displayed stronger overall performance during year 2024. Thank you.
Hello everyone, my name is Laura and I'm going to summarize the market ratio analysis for both companies. So first of all, overall, I would like to highlight that Woolworths company demonstrated a stronger market performance during the years 2023 and 2024. And the company reported higher earnings per share, dividends per share, market share prices, and a stronger price to earnings ratios, suggesting that stronger earnings performance and greater investor confidence. Also, Woolworths company also maintained higher retention ratios, indicating a greater focus on reinvesting earnings to support future growth. And in contrast, we have Coles company, where they achieved stronger dividend yield ratios, which suggests better returns for shareholders. Also, both companies experienced a decline in market share prices during the year 2024, and Woolworths company maintained a stronger overall market positions and was therefore identified as the stronger performance in this category. As discussed in the market ratio analysis, Woolworths demonstrated a stronger market performance through higher earnings, market valuation, and earning retentions, while Coles company delivered stronger shareholder returns. However, market ratios represent only one aspect of financial performance, as we know. To make a balanced assessment, it is important to consider all ratio categories together, of course. So this slide provides an overall comparison of both companies across profitability, liquidity, efficiency, and market ratios. And their results show that neither company outperformed the other in every category. And for Coles company, they demonstrated a stronger operational efficiency supported by better asset utilization, inventory management, receivable collection, and also stronger shareholder returns through higher dividend yield and payout ratios. And in contrast, we also have that Woolworths they achieved stronger profitability and market performance, and the company reported a higher gross profit margins, a stronger market valuation, and higher earnings per share, and greater earnings retention, indicating a stronger long-term growth potential. Also, the ratio analysis provided very important and valuable insights into the financial performance for both companies. We consider that additional information will be helpful to support a more informed decision. And firstly, we consider that it will be important to also understand the future outlook of the Australian supermarket industry. And this is important because it's particularly important to consider inflation, also rising operational costs and ongoing competition. Secondly, we also consider to analyze economic risks that may influence in consumer spending, but also future financial performance. And it is also important to consider future expansion and investment plans for the companies because this may affect long-term growth opportunities. Finally, non-financial factors such as sustainability practices, corporate governance, and employee satisfaction overall should be evaluated because they can influence reputation but also operational performance and long-term business success. Overall, both companies performed strongly across the financial years that we analyzed. And Coles Company demonstrated a better operational efficiency, stronger dividend returns, and improvement in several efficiency ratios. However, Woolworths achieved a stronger profitability and market performance, supported by higher earnings per share, market valuation, and earnings retention. And based on the overall ratio analysis, Woolworths is recommended as the preferred company because it demonstrated a stronger combination of profitability, financial stability, and long-term growth potential, while Coles Company remains a highly competitive and financially healthy organization.